Markets rarely reverse without warning, but occasionally a soaring upward trend abruptly shatters, driven by forces entirely invisible to the average trader. In early June 2026, AMD was riding a massive options-driven breakout, pushing up more than 52%. But by the close of trading on Thursday, June 4th, that momentum completely and violently fractured. AMD's spot price collapsed from a $542 peak down to $526, while implied volatility hyperinflated into the 97th percentile. This extreme shift occurred without localized news. The surging SOXL put-to-call ratio confirms it was an entirely derivative-driven event. To understand why AMD crashed, we have to map the chronological macro-to-micro transmission model. We will track exactly how a completely separate asset, Broadcom, triggered this collapse. Isolated strength in a single stock cannot hold up against a systemic liquidation vector when an anchor asset cracks. This chart capturing Phase 1 shows the extreme extension on June 1st and 2nd. Aggressive, non-discretionary out-of-the-money call block sweeps forced options dealers into an accelerating delta hedging loop, pushing AMD 52.6% above its 50-day moving average. That dynamic forced those dealers into a constant automated buying cycle, temporarily defying standard statistical gravity. By Phase 2 on June 3rd, retail and institutional buying culminated in a divergent climax, pushing AMD to a closing high of $542.52. But a hidden cross-asset warning flag appeared concurrently. The broader semiconductor fund, SOXL, completely stalled intraday at a $300 ceiling on massive volume. SOXL's implied volatility completely maxed out at the 100th percentile. Options premium costs had hit an absolute mathematical ceiling. Once localized options premium costs hit that 100th percentile ceiling, the asset's micromomentum becomes highly fragile. It requires a constant influx of new macro capital just to maintain its current price. To see where that capital drained away, we have to look at the underlying market architecture. Modern institutional capital relies heavily on highly liquid, market cap-weighted, triple-leveraged index funds. This network diagram illustrates the consequence of that allocation. Stacking multiple leveraged vehicles creates massive, hidden, single-name concentrations. Broadcom and NVIDIA are the structural anchors. They sit at the absolute center of this system, acting as heavyweights across all 5 major tech ETFs. AMD, however, occupies a concentrated but secondary position within 3 of those exact same funds, SOXL, TECL, and TQQQ. Allocating institutional capital through intersecting leveraged vehicles creates a hidden, single point of failure contagion risk. It directly links seemingly uncorrelated single-stock derivatives together. Which brings us back to Thursday, June 4th, and that central anchor, Broadcom. Looking at the contagion mechanism, the primary fracture occurred when Broadcom plummeted 12.59% intraday. It broke cleanly below its opening bell pivot and slid beneath its $435 max pain node. Because of the strict mathematical mandates of triple leverage, an anchor failure of that magnitude immediately compromises the entire fund's daily balance. This triggers algorithmic basket liquidation. Fund managers for SOXL, TCL, and TQQQ are structurally forced to dump their baseline underlying index shares at the market close to maintain their leverage ratio. That non-discretionary basket selling bypasses human logic entirely and spills straight into the secondary assets, violently draining liquidity from AMD. This algorithmic selling completely starved AMD of macro capital inflows, dragging its share price below the critical $527.50 technical pivot point. Algorithmic basket liquidation is the overriding systemic vector here. It mathematically transforms an isolated anchor asset's failure into a sector-wide liquidity drain. Once AMD was dragged below that $527.50 pivot, the options market reacted. The asset fell into a gamma trap. The initial delta hedging loop that had pushed AMD upward violently reversed as long call deltas began to collapse. Market makers holding short gamma exposure were instantly forced into automated basket liquidation to rebalance their books. Options dealers transitioned instantly from forced buyers to automated liquidators, dumping equity shares into the open market to maintain delta neutrality. This resulted in a dual-layered crash. The ETF basket selling provided the initial gravitational push, but the localized short gamma unwinding accelerated the downward velocity, pinning AMD at $523.20. Dealer positioning transforms from a localized tailwind into an unyielding structural headwind the moment critical mathematical floors are broken by macro ETF forces. Moving into the Friday, June 5th open, the market enters the terminal 0 days to expiration phase. In a 0 DTE environment, options positioning transitions from a fluid hedging model into a highly restricted, high-velocity expiration loop. This forward outlook isolates the risk vector for AMD. The stock is trapped at $523.20, dangerously separated from its true max pain node of $485 to $490. If AMD fails to immediately reclaim the 525 strike, terminal theta decay takes over. Remaining call premiums will evaporate, rapidly accelerating the unwinding of long delta hedges straight down. Compounding this is the sector drag risk. The overarching SOXL fund remains trapped below its pivot, ensuring automatic de-hedging will apply an unyielding downward gravitational pull across all semiconductor stocks. Firm, conclusive. In heavily financialized markets, single stock options momentum is an illusion. The underlying ETF microstructure and structural dealer positioning ultimately dictate price reality.